Do you ever feel like your Forex trades are being hijacked by the unpredictable moves of the US dollar? If so, you're not alone. So many of you have asked me to do a video on how to trade Forex currency crosses because you know that there are opportunities there. These are pairs that exclude the US dollar. And today, I'm delivering. This is what this video is about. These pairs let you focus on the pure fundamentals, and they provide more predictable and hopefully profitable trading opportunities. Welcome to today's Forex currency crosses video. We're diving into what Forex currency crosses are, why they matter, and how to trade them effectively. I've got some great tips for you. If you've ever felt stuck trading dollar-denominated pairs and wondered how to tap into opportunities beyond the majors, this is the video for you. Because oftentimes, it's either dollar up or dollar down. At the end of the day, you'll understand why these pairs are some of my favorite to trade and how they can add a whole new dimension to your trading strategy. So let's get started. And let's start by talking about what are Forex currency crosses. In Forex, every trade involves two currencies, a base currency and a quote currency. For example, in Euro / the USD, you've got Euro on one side and the USD on the other. Now, there are pairs that exclude the US dollar, and these are the currency crosses like Euro Pound or the Australian dollar against the Japanese yen. One important thing to know is that different currency crosses have different point values. This is one of the most important things to know. And these are known as pips in Forex. For example, a single point in the Euro British Pound pair is worth about double what a point is worth in Euro Aussie. So for 100,000 units, that's about $12 a point for Euro Pound compared to $6 for Euro Aussie. Knowing this is absolutely important because it can make a huge difference when you calculate your potential profit target, your stop, how much you're willing to risk, and where you want to put your levels. Now, luckily, many platforms do the work for you and they show you how much these points are worth. And if yours don't, I've actually included a link to Simple Calculator in the description of this video. But I cannot stress the importance of understanding point values because it is the key to properly sizing your trades and managing risk effectively. I mean, pound yen might seem like it has huge moves compared to Euro Pound, but then Euro Pound point values are much bigger than pound yen. And that's not something that many traders know right off the bat. So if internally you say to yourself, I've got a $500 maximum loss that I'm willing to take per trade, then one of the important things to know in relation to this is that a $500 maximum stop per trade is actually more points or pips in Euro Aussie than Euro Pound, for example. So if you've got a $500 stop in Euro Pound, it's going to be fewer points or pips away from your entry than Euro Aussie. Whereas Euro Aussie, it could be double that amount. So, it could be even more specific. If you have a stop that is 30 pips in Euro Pound, that is worth 60 pips, for example, rough give or take, in Euro Aussie. And so you have more leeway. And that is why understanding the pip values and the point values is one of the most important things, the first thing that you need to know about trading currency crosses and position sizing. And once again, in the description of this video, I've included a link to a pip calculator. So if you want to learn how to trade currency crosses, this is the first thing that you need to know. Now, here's why currency crosses could be a game changer. Most traders focus on the US dollar pairs, where the dollar's performance and the demand for dollars can completely overshadow everything else. For instance, even if the euro is weakening for a variety of reasons, if you also have US economic data weaken, you can actually see the euro dollar rise in value. And this may be confusing for some traders and be tough because if you're looking for a purely fundamental based trade, you need to look outside the US dollar. And that's where the opportunities in currency crosses come in. These pairs let you eliminate the dollar's influence and focus solely on the unique dynamics between the two countries and currencies that you're focusing on. For example, if you're trading Euro Pound, it allows you to directly compare what's going on in the Eurozone compared to what's going on in the UK, which country is performing better, which central bank is raising or cutting interest rates, and which one is not. So this allows you to do this without the interference of the US dollar sentiment. Now, to trade currency crosses properly and profitably, you need to understand a few things. Number one, volatility. Some crosses like British Pound against the Japanese yen or Euro Aussie are known for big moves, and they are perfect for traders who thrive on action. But remember, higher volatility means higher risk, so you always need to use disciplined risk management. The second thing is timing. Different sessions favor different currency crosses, and this is very important. During the Asia session, pairs like Aussie-Swiss and Kiwi-CAD tend to be more active, while in the London session, you may see Euro-Pound and Euro-Swiss be more active. I always talk in many of my videos about the importance of timing, because timing your trades properly can make all the difference between winners as well as losers. The third is trending versus range-bound pairs. If you love trends and you love to trade big extended moves, then the Euro crosses like Euro Aussie, Euro Kiwi, or the yen pairs like Aussie yen you might want to look at. If you like to trade ranges, Euro Pound, Euro Swiss, Aussie Kiwi may be better for you. So you want to tailor your strategy to match the pair's behavior. My trading partner Boris always likes to say that no one trades currency crosses better than I do. And while I'm certainly that's not true, and there are plenty of people who try to trade it better, crosses are indeed my favorite and my most profitable pairs to trade. And here are some of the reasons why. Now, you may also know that I trade the New York and Asia Open. And in the Asia Open, the Euro crosses are my bread and butter. They're incredibly trending during the Asia session, often moving fast and hitting my profit targets in that same session within an hour or two of my entry. So let me show you how they work. This is an example of Euro Aussie, one of my recent trades and one of my favorite pairs to trade. On this day, we actually have very weak Australian GDP numbers at the Asia Open. These numbers came out at 7:30 p.m. New York time. And that triggered a breakout and a zip buy signal, which is my strategy. And that's the white candle with the green background. This is the perfect setup because it combines fundamentals with technicals, the cornerstone of my trading strategy. As you can see in the Euro Aussie chart, the currency pair rose steadily throughout the Asia session into the European Open with very little retracement. This is the type of clean, sustained move that makes trading Euro crosses so rewarding during the Asia session. And this is actually a small move. And often, the easiest pairs to trade are the Euro crosses during the session. These crosses are particularly great for day traders or swing traders during the Asia session because the dynamics are so clear, and usually you're either right or wrong. Either you're right and it continues to go, or you're wrong and the direction is wrong and you're gonna get stopped out. Here's why. In Asia, there's typically no European news flow. This creates one of two scenarios. Either the euro holds steady, doesn't do anything, and the market bids up the Aussie or Kiwi based upon what's happening in those countries. Or the euro moves based upon positive, negative news flow of the New York session, and the commodity currencies do not move at all. Both scenarios could lead to big, predictable moves in euro crosses during the Asia session. And these pairs often, as I said, trend strongly, and they'll hit my profit targets in the Asia session itself. And if it moves against me, I'm probably wrong, period. And I don't have to stay in the trade for very long. And even if I have to carry the trade into the European session, more often than not, the trend continues, making Euro crosses a reliable choice for me. The New York session offers more and different opportunities, particularly involving the Canadian dollar and the Japanese yen. Here, I like to focus on the continuation trades that capitalize on trends that began during the Asia or the European sessions. For example, if Euro yen surged overnight due to strong Eurozone data, that momentum will oftentimes carry into the early New York session before US data is released, giving me a nice window to trade before the US economic data hits. With that said, here are some other things you need to consider when you are trading currency crosses. The first is that you need to stay on top of fundamentals. Crosses rely on understanding the economies behind each currency. Keep an eye on what the central bank is doing. Are they talking about cutting interest rates or not? What's the economic data doing? Has it been stronger? Has it been weaker? And are there any political or geopolitical events affecting the currency? 2, beware of liquidity traps. Different crosses have different spreads, and they can lead to unpredictable moves during certain times of the day, so be careful about that. You may want to stick with well-liquid pairs like Euro Pound or Aussie Yen for more consistent trades. 3rd, risk management is non-negotiable. High volatility pairs can move fast against you, and with Euro crosses, if you're wrong, it's going to move against you quickly. You should just be out. So make sure you position size and protect your capital properly. I hope you've gotten a better understanding of why currency crosses can be on your radar and how to trade them. Forex crosses aren't just an alternative. They're a powerful way to diversify your trading portfolio and give you more opportunities. They let you trade pure fundamentals and avoid dollar-driven noise, especially when the dollar is overextended, and even unlock session-specific opportunities for clean trends or tighter trading ranges. Whether it's catching a Euro cross trends in the Asia session or CAD Swiss continuation trade during the New York Open, crosses could become your secret weapon. I know they're mind. With practice and discipline and the strategies and the techniques and the tips that we've covered, I hope you'll see why they are my go-to pairs for my day-to-day trading. Finally, if you found this video helpful, please click the like button, subscribe to our channel, and turn on notifications so you don't miss more tips like this. And if you want to take your Forex skills even further, check out the description for a simple calculator on the pip values and some hand-picked courses designed to help you become a better trader. Let me know what your favorite currency pairs are to trade. Is it a cross? Is it a major? Drop it in the comments and let's start a discussion. Otherwise, until next time, trade smart, stay focused. I'll see you in the next video.